Hi there, everyone, and welcome to this edition of On Track. I'm recording this on 31st of August, and we've got news right up to the minute, including the latest inflation numbers, investment performance for the funds to the end of July. I'm Rob McGregor, and this video podcast is for clients of McGregor Wealth Management. And for those of you who aren't clients, feel free to listen in, but please don't act on anything in this unless you get advice that's specific to your own circumstances. So another interesting month in the world, and today I'm going to dive into some of the economic news, put into context with the markets, update what the returns and what the key market's been doing. Couple of topics, hot topics. I'm going to talk about the Magnificent Seven. That's the AI-driven stock boom in a handful of stocks. I'm going to give you the latest update on inflation, interest rates, and talk about what the new normal might be and how long that might take. And we're going to have a look at what's happening with property and share markets and some interesting research that's come out of what people actually did with their investments during COVID, which is fascinating. And as usual, put all this in perspective to help you make better decisions with your money. So we look at the news that came through. Share markets had a really good July. They eased through August, and that was basically on a bit of a relief rally after the markets had gone strong. Both the RBA and the Fed have paused interest rates, waiting for data to assess the impact. Higher interest rates have a lag effect. It takes many months for that to fully impact. We're seeing really good inflation numbers in both the US, and if we look down at some of the numbers, cash rate unchanged, 90-day bank bill rate down slightly to 4.14, 10-year government bond yield up a fraction, and it went up a bit higher. We'll have a bit more of a look at that. Aussie dollar dropped down to about 64 cents and has come back a little, 65 at the moment. News from just yesterday, the annual month-on-month inflation rate is dropping. Looks like good news. That means it's likely the Reserve Bank will probably pause for a bit longer. The markets only rate about a 3% chance for rates to increase in the next few months, so probably unlikely. US inflation staying stubborn around that 3% mark. As for Australia, they'd like to see that in that 2 to 3% bracket. And one of the big questions is, will it drop down into that, or will it hover in the 3s or 4s? And I'll talk more about that in a minute. Mortgage rates, hard to get mortgage rates with a 5 in front of it. You can just get it, but most of them, around in the early 6s, but you can get certainly Macquarie for people with low LVRs, 5.89, and there's one other special out there at 5.79. The crazy good news on all the interest rate is for those of you with term deposits. You're seeing the best rates in years, so 1-year term deposits at about 4.9%. And we'll talk about the RBA forecasting a return to that target range of 2 to 3% by late 2025. So obviously that's effectively 2 and a bit years. It's interesting how the banks see it. So the 4 bank economists are down there. All 3 of them view rates as having peaked. One of them, from the NAB, thinks rates might go 1 step higher, although I suspect they may wind that back today after that latest news. And they're assuming that rates have peaked and that they'll drop. Also, again, some of them saying by the end of 24, some of them saying by early 25 or the end of 25. Now, as we remember, forecasters, economists, no matter how smart they are, have a pretty terrible track record of forecasting anything. The world, particularly when it comes to these things, is much more complicated than any model, and so many things have impact. And we remember how even the governor of the Reserve Bank got it all wrong, thinking that low rates would be here till 24. Obviously, vastly wrong. But it looks like it's heading in that direction. There's always a chance, when you've got everyone agreeing on something like, till late 25, that it happens sooner. But there's also a chance it happens later. Let's jump in. Let's have a look at the portfolio returns. And you can see there solid returns. When I look at this 7-year returns across the care combined portfolios, they're right in line with their long-term targets, despite it being a tumultuous 7 years. With balanced care portfolios just under 7%, which is easily hitting the inflation +4 target. Last year, the 1-year returns to the end of July, very good, 10% plus for balanced growth and high growth, 7-ish for the moderate. So good solid returns. As I said, the markets have come back in August. With that pullback in August, we had our investment committee meeting on Monday. We now view the markets as neutral. And apologies, my little indicator hasn't come up there. We've got the dial on a 7, so completely fair value neutral. So a safe time to be investing. Neither cheap nor expensive, just neutral. And we can see that come back here, the pullback there right at the top right-hand corner. And the market's stuck in that range. It doesn't want to break higher than that sort of 7.3, 7.4 mark, the ASX 200. And that's because the market's not sure about where all this goes. The impact of higher interest rates means we're likely to have a slowdown in most of the economies around the world. Some of them may have minor recessions, very shallow recessions. And the market's sort of waiting for the news to get more clearer. We've just come out of the profit season in both Australia and the US, and profit numbers were pretty good, although there were warnings in a lot of those profit numbers that there may be slowdowns this year. And that's understandable given the uncertainty. And let me talk on one of the topics you may have heard about, but the Magnificent Seven. So the Magnificent Seven is companies like Amazon, Microsoft, Google, NVIDIA, Apple, that all have an interest in AI or artificial intelligence. The world was surprised a bit by the advancement when ChatGPT was launched just under a year ago, and the rapid uptake of that and the impact. As usual, when there's major technological advances, markets often get ahead of themselves. So you can see the top left-hand chart here. The top line is the Magnificent Seven. So in the year to June 30, they're up 86%. Now, when they all form part of NASDAQ, NASDAQ itself was up 39%. But obviously, if you took out the Magnificent Seven, the returns would be much lower. And if you go to the S&P, healthy returns of 16%. But once again, all those Magnificent Seven also make up the S&P. So returns lower. And when you go down to the Dow Jones, which is more old school stocks, just a 6% return. So all the returns out of the US are coming from that tech space. They have come back, as you can see by the chart down the bottom. Although NVIDIA is a chip maker that's used in supercomputers that fuel artificial intelligence. And even though they came back, they bounced straight back up again. And they're one of the key drivers. You'll see NASDAQ, though, has retreated from its highs, and as has the broader S&P market. Now, NVIDIA will probably continue to make highs. The hype around new technology often leads to massive bubbles. This is very early stage. It's fairly recent, and make no doubt this will drive bull markets over the next decade. And it's quite likely that this will provide massive productivity improvements for all companies. And in these booms, when we get these tech advancements, and we saw this in the late 90s, early 2000s with the internet boom and bubble, where the stocks at the leading front of the internet boomed, but the results in productivity, the gains in productivity were shared across the broader market over time, and the boom eventually led to a big crash in the States. This is just the start. This is a good thing. AI will actually improve profits of companies. It's going to be a tailwind on the global economy. No one's quite sure how much yet, but it's good news that will slowly come out and be clouded by, you'll hear people saying, oh, there's a boom or a bubble on. It's early days, and it will affect all companies over time. So some good news. When we look at the yield curve, interest rates, and crazy to look at the difference between Aussie and US. So we've got a lower cash rate at 4.1%. The US has a higher cash rate. That translates into borrowing rates, and I'm going to talk about that in a minute. Our 10-year bond rates are almost the same at about 4%, but we've got that lower front end of the yield curve. So this is pretty much predicting the rates are going to drop over the next 2 to 3 years, which is what I talked about before. Not so much in the States, they're predicting a little bit more. But one of the key differences here is that Australia has mostly variable rate mortgages. There's obviously a lot of fixed rates that are coming off in the next little while. So increases in the cash rate by the RBA go straight onto mortgage rates, and that hurts the consumer. In the US, it's different. They have mostly fixed rates. So when you take out a rate, it's a 30-year fixed rate. So if you took out a loan 3 years ago, it will be on those rates. So as they put up rates, it doesn't flow straight in. It does affect lots of things like corporate borrowings and things like that. So it has an impact, but not the same. And that's kind of the explanation for that different shape of the short-term yield curve, with the view that in Australia, certainly the pain is being inflicted, particularly on young mortgage holders with high mortgages. And that's leading to the slowdown, which is why they're doing this. That's inevitable. We're seeing rates sort of steady, although in the month of July, August, they jumped up almost to the mid-4s before coming back, but around 4. And I'll talk about in a minute what a new normal might look like. To put it into context, we're quite firmly in the wall of worry in what we'd say is neutral. So wall of worry fair is where we rate the market at the moment. Neither expensive nor cheap. No crazy news on the negative or the positive, which makes the likelihood of major downturns pretty low, unless there's some huge shock that's unexpected, like a COVID. But we're certainly not in any boom stage for the broader markets. As I said, we've just brought the dial actually back to 7. I'm not going to go through those downturns today. Refer back to previous episodes. A couple of things I want to focus on today in our mess it up, which is just an acronym for the different ways that people mess up their investing. And we know from the long-term Delbar studies that the cost of this is massive. So on average, most investors tear up more than half of the investment returns, in excess, somewhere from 3 to 5%, depending on the time frame you look at, by bad decisions. So they make wrong decisions at the wrong time. Now, because all of our clients don't do that because of having a good long-term plan, educated about the natural state of the normal state of markets in that they fluctuate. We just don't see that in our clients. And every now and then I think, has this changed? Surely everyone now knows you shouldn't attempt to time the market, but they actually do. There's some really good data in. I'm just going to jump. Actually, I'll come back to that, hold that thought on the data in. But I wanted to talk first about what the new normal for rates might be. So I've got up, this is all Australian data on here. So in the top left-hand corner, we've got inflation. It's still too high, but as I said, some good news last night, it's dropped again. So it's coming down, it's heading towards that range. But keep in mind, the RBA's got to get it into the 2 to 3% range. It hasn't been there since post-COVID when it broke out above that, but it was below that for a long period of time, all the way back through 2010. There was sort of sub-2s, occasionally up to 3s. So the cash rate has been pushed up massively, which is the bottom left-hand chart, and that's designed to hurt the economy, to slow down growth, to slow down inflation. So it's exactly by design. It's the only way they know how to do it, as brutal as it seems. So they're now pausing because it looks like that's coming through. But we don't know what is the neutral rate. So the neutral rate is the rate where there's no inflation, but the economy is having reasonable growth and unemployment is at a reasonable level. So at this stage, we don't know whether the 4.1% that we've got right now is high or whether it's the neutral rate. There seems to be consensus among economists, but once again, warning, economists don't have a great track record here, that rates will come back a little, maybe into the 3.5 sort of space, but we won't know that till we know the economic results. But there's this perception, and this is what I want to talk about, that the current rates are high. But when you look back over the last 25 years, which we've got here, 4% would have been considered fairly low. Now, we did have a period where from 2012 through to 2020, rates were pushed down because world growth was very sluggish, very slow. So they're actually trying to, and inflation was sub 2%. So they're actually trying to get it up. They're worried about deflation. So is this the new normal, or are we still a little bit high? Because where it impacts is two things. Government bond rates on the right-hand side here at 4%, and then you got mortgage rates. And if you look at the slope of those curves, you'll see they track each other almost perfectly. That is, as rates go up and down, so too to mortgage rates. So mortgage rates have had this increase from the crazy levels of 2%, which no one had ever seen before, back into around the 6% again at the moment. And everyone's thinking and feeling like this is high, and it's certainly high relative to the last 8 years, but we're really back to about 8 years ago, and a rate of 6% would have been considered low for the previous 50 years. So we've got this this big question hanging over: what is the new normal for rates? What rates might get to, and where we go for mortgage rates. We kind of have a not a tightly held view on this, that rates will probably ease back a little over the next 18 months somewhere, and that will result in mortgage rates coming back a little, but not necessarily a lot. But there's a chance that we can be wrong on the high side and the low side there. We could get back to the pre-COVID levels where world growth is sluggish and we have some deflationary forces. So rates could drop back into that 4 to 5% range. Now, it wouldn't actually be good news. It would be good news for mortgage holders, but it wouldn't be great news for the economy. But we could also have the possibility where inflation gets stuck in this sort of 3 to 4.5% range. So it's above the targets and not coming down and stubborn. And we just don't know whether the Federal Reserve in the US and the Reserve Bank in Australia and other monetary authorities will push rates up higher to get it back in, or whether they'll put up with rates there to not have too much unemployment and too much slowing down of growth. So that's kind of the discussion on the new normal. I want to look at, in line with what I was saying before, another behavioral bias, which is the action bias. So the action bias describes our tendency to favor action over inaction, often to our benefit, but there's times where it's not to our benefit. You've often heard people say, don't just stand there, do something, which in many cases, when there's something bad going on, is the right thing to do. But in the markets, it's often the opposite. It's don't just do something, stand there. So when we're hearing bad news, the markets have gone down, we actually want to sit still and hang on to our investments, because by the time they've gone down, the bad news is in, and we don't necessarily benefit by doing that. Now, as I said before, I keep thinking, because we talk about all this time with you guys, that the broader public must kind of know that this sort of behavior is detrimental to their long-term returns. And as I said, it costs them 3 to 5% over their lifetime of investing, which is huge. But have a look at this data that's come from Griffith University and my colleague on the Care Investment Committee, Professor Mark Brimble, and they got hold of a whole bunch of super fund data, industry super fund data, that looked at the behavior of the members in terms of switches. The red bars here are single switches and the blue bars are multiple switches. And look in the middle, that aberration where people did multiple switches. And when did they do it? During COVID, when markets were down. So they were making those switches while the markets were falling, obviously getting out of shares and into more conservative options. And when did they get back in? After markets had risen. And it's quite damning. It just confirms that the broader public will continue to make these behavioral mistakes, which cost them money over time. And yeah, as always, very pleased for our clients that we obviously don't do that. And that's resulted in above average returns, not only from the markets, but from your behavior. In terms of the pillars that sit behind the core investment strategy, the one I'm going to focus on today is managing liquidity. So liquidity just means having enough money to ride through a crisis, to have cash available so that you never have to sell good assets at a bad time. I remember our 3 reasons people lose money: have to sell when markets are down, panic and sell when markets are down, or not truly diversified. I'm going to talk about diversification in a minute as we go through each of the sectors, and we have massive levels of diversification. But the liquidity, the boring old reserves for our retired clients, means they never have to sell at a bad time. And that means they've got cash to fund lifestyle, cash to fund other payments. And it's why when someone tells us they're thinking about buying a new car or taking a big trip, we look for the best time to pull that money out or to pull it out of the reserves. So highly important. Let's have a look at what the markets have done, and we'll visit in on diversification as we're doing it. So Aussie Shares, a good month, up 2.9%. You'll see though on the top right-hand chart, it has retreated a bit in August. So at this stage, it's given up most of those gains, but it had been a healthy year, 11.15% for that year. 3 years at about 12%, 5 years at 7.5%. So pretty healthy when you consider we had a global pandemic. Things are going okay. Down the bottom left-hand corner, I've got an extract from the Vanguard fact sheet, which is the way we get exposure to the Aussie market. And so by holding VAS in your portfolios, you get exposure to 300 holdings. So that's all 300 companies that make up the exposure there. It's a massive diversification. And an investment in VAS of $10,000 10 years ago would be worth, with dividends reinvested, about $24,000. So yeah, a great result and well above the average of funds in that space. For US shares, similar story, up 3.34% for the month. Not down as much since then, partly due to the Aussie dollar dropping a bit. Very healthy over 1 year, 18.5%, 3 years, 15%, 5 years, 13%. So very good numbers. Part of that's been helped by currency, the Aussie dollar weakening a bit. But when we look at VTS, which is a holding we have in the core portfolios that gets us exposure to US shares, it has 3,861 companies. That's crazy. So incredible diversification. You own the best of companies in America, pretty much the whole economy. So when we see things like the Magnificent Seven going up, guess what? You own those companies as well. You don't need to chase them separately, and you'll see that growth in that bottom right-hand corner, the 10-year chart. That growth, that last growth spurt, is absolutely being driven by those AI stocks, the Magnificent Seven, and yeah, that's good for our portfolios. And $10,000 invested 10 years ago, worth 57, nearly 58,000 10 years later. So a stellar return. And those that didn't have international shares over the last 10 years have missed out on, one, the diversification, but two, better returns over that period. Similar for global leaders. So these are the top 100 companies. So we get exposure here through IOO, up 1.37% for the month. Pretty steady since over August there. This includes a lot of those stocks. So when you go Apple, yep, in the Magnificent Seven. Microsoft, yep, in the Magnificent Seven. Amazon, Nvidia, Alphabet, and Facebook, which doesn't show in here, but all in that Magnificent Seven. So all doing very well. And they make up 53% of this portfolio, those top 10 stocks there, which does include some old school stocks like Johnson & Johnson, JP Morgan, ExxonMobil, and Procter & Gamble. An investment of $10,000 10 years ago in IOO, now worth $47,800. So quite spectacular what good compounding growth does. So that's compounding over 13.8%. Now, about 3% of that was due to the drop in the Aussie dollar over that time, which acts as a tailwind for overseas investments. US small caps, which is the smaller end of the US market, and the number of holdings in IJR, which we hold in both our core portfolio and the active portfolio, is 679. So another incredible amount of stocks. You won't tend to recognize those names. This is the middle America. It's not the giants, but it's the bread and butter that makes up the economy. And we know that small caps outperform large caps over the long run because it's where innovation comes out of, and growing companies, and a 10,000 investment there worth about 54,000. And this is with dividends reinvested. Yeah, 4.24%. So good month, good result for the month. Has come back a bit, as you'll see in the top right-hand corner. And we view that as fair. 8.69% for the year, 17.7 for 3 years, 7.4 for 5. So in line with what we would expect in the longer term and contributing to the portfolio well. Emerging markets had been very poor, but it's actually printed its best year for a long time. You can see the 3 and 5 year returns are still very low, about 2%, but the last year it's actually up 10.86%. And you can see that both in the top right-hand chart, but also the bottom right-hand chart, where the last year we're seeing a bit of a comeback. Emerging markets still look very cheap, assuming we get back to sort of that normal high growth that comes out of emerging markets, which is places like China, India, Taiwan, South Korea. You'll see the top holdings there, companies like Taiwan Semiconductor, obviously from Taiwan, Tencent from India, Samsung from North Korea, Alibaba from China, etc. So we get good exposure. With the Chinese economy, a few question marks over at the moment. That's bought some of this stuff back in the last month with the the very real slowdown in the Chinese property market. And that's what's led into our share market being slower this month as well, where they're worried that that might impact the Australian economy, and it will, but there's also a chance the Chinese government pushes massive stimulus to keep that economy growing at their target rate of 5%. But we'll see where that goes. Gold, great 1 year, 15.73%, 1.69 for the last month. Pretty low over 3 years, but over 5 years, 11.74%. An incredibly valuable part of the portfolio through COVID. Not as much growth over the long term, 10,000 to 17,000, but gold is so valuable in the portfolio for its diversification and the fact that it's almost like an insurance policy. When the rest of the markets tend to go down, gold tends to go up, so it acts as an insurance policy across the portfolios. Let's look at the property market at the moment, and our framework around this is that boom, bust, boring, and then most of the time the property market is in the boring phase. I'm kind of there to a degree at the moment. Eventually we have a boom, which we've seen particularly from most of the market in the last few years, followed by a bit of a bust or downturn, often not huge, followed by long periods of boring or slow growth. Let's have a look at what's actually happening out there. The last month has seen growth of around 1% around the country. And keep in mind, the numbers vary very specifically when you get down to suburbs. And even in places like Sydney, we're seeing very different results out in the mortgage belt, where mortgages are high, compared to some of the affluent inner suburbs where mortgages are very low and property values are high. So where there's high mortgages, there's much more impact on property markets at the moment. Where there's low mortgages or no mortgages, less impact. Over the last 12 months, you can see the difference in the cities. Brisbane down 3.6%, Melbourne down 2.5%, Adelaide up 2%, Perth up 4.2%. So very different. And you can see when you put all that together, it was a neutral year across the country. And this bottom chart down the bottom just shows the rolling changes over the last period, and we've had that downturn over the last few months, but after a very good upturn, the bottom of the market there is sort of coming through 2020, which has been cut off there. So so property market's very much in the boring phase at the moment, but it's interesting. Some of the news literally last few days out of CoreLogic, the auction rates, and we're coming into spring where auction numbers increase, and lots of real estate people would say it's one of the better times to sell. And a sign of a healthy market is where you've got high auction clearance rates. And when you look around the country, auction rates are higher for the last week than they were at the same time last year, across the board, except for Canberra, where they're slightly lower. But everywhere else, auction rates, clearance rates are high, very high in Adelaide, solid in the rest of it. And the auction numbers are also increasing as well. So when you've got higher clearance rate and higher auctions, it tells you there's healthy turnover in the market. Now, the rental situation, so the bottom right-hand chart here shows what's happened to rents and yields on property, which is driven by the rents and the prices. And you look at the change in rents over the last 12 months, and that 12 months gone, Sydney 12%, Melbourne 12-ish%, 10%-ish in Brisbane and Adelaide, 13% in Perth. So rents rising, less so or not at all in Hobart, Darwin and Canberra. Canberra's actually retreated after an incredibly big uptick. You can see the rental values. So median rent in Sydney, $735. The cheapest one around the country is still Hobart at $546, just behind Adelaide. But once again, these are big numbers, and up across the country about 11%. Because prices have gone up as well, yields have gone up, but not quite by as much. And you can see the highest yield is in somewhere like Darwin. But keep in mind, Darwin's only 300,000 people. Got to have a lot of care in investing in Darwin. It's much smaller than the other cities. Hobart 4.2%, Perth 4.8%. One of the reasons we still think Perth is a highly suitable investment location for those looking for good investment properties, and vacancy rates are still extremely low. If you look at the current vacancy rates versus a year ago around the country, they're actually lower than a year ago, 1.2% versus 1.5%. Varies a little bit from state to state. For instance, they've gone up in Hobart, but most of the states they've gone down. A little bit up in Brisbane, but still incredibly low by historical standards. Rates, not much has changed on rates as the RBA holds steady. Rates still in the sixes for the most part. If you fight hard, you can get closer to 6 or just under. If you're coming off fixed rates, you should get your mortgages reviewed by your bank and negotiate to get the lowest rate you can. If you're not having a joy with your bank, reach out. We can introduce you to mortgage brokers who can help you get the lowest rate possible. We're seeing a difference of about 1% in the worst rates versus the best rates. 1% on a $500,000 mortgage, $5,000. On $1 million mortgage is $10,000. Highly worthwhile focusing on that. Fixed rates are all about the same in that 6% space. So the market isn't expecting much change in rates. This is the banks effectively saying rates are not going to change much in the next 5 years. We'll see where that goes, but that's the view of the money markets at the moment. There's always two reasons to fix rates. One is for insurance, just so you know what you're going to pay, and for people that like to know what they're going to pay, it's okay to fix rates. The other is to lock in good rates, and at the moment we don't know whether these rates are good or bad. When we look ahead, there's probably more chance that rates will drop a little bit over the next couple of years, but it doesn't look like it's going to be huge. And feel free to ignore my view on that because it's an incredibly hard one to get accurate and very few people do. But yeah, fairly neutral at the moment. Our friends at Performance Property, their latest update on the property clock as they see it, based on their research, which is some of the best that I see in the property market. They pulled back some of the places like Melbourne were up right at the top. They pulled it back a bit as they're seeing a good run. So markets haven't come back, so they wind the clock back a little bit. But we've still got places like, particularly New South Wales, where the markets kind of looks toppy in their view, and is actually coming down in some areas. At the bottom of the clock, where there is the most value, is primarily Perth and regional WA and regional Queensland is where they see the most value, but still reasonable value around Brisbane and sort of southeast Queensland, although Sunny Coast and Gold Coast have had a good run. As always, be careful around long-term property investment. We can help you make some good decisions around that and make sure it's factored into your plan. But yeah, reach out if you're looking for some help around that. So wrapping up, as usual, we have that fundamental belief that all investing is best done as part of a real plan, based on your goals and your situation, portfolio designed to meet those goals. We do take a long-term view, but we do have a short-term opinion, and we get back to principles because, as I've said, often forecasters, including us, can never tell what's going to happen in the short term. So much better to invest based on principles that have proven to be valuable over the long run. Things like diversification, asset allocation, and liquidity, making sure we've got low-cost exposure, protecting against the short-term volatility through reserves and dollar-cost averaging, and boring old rebalancing consistently adds value to our returns. And avoiding those three ways to lose money that I talked about: not panicking, not having to sell, and not properly diversified. As you've seen today, you have massive diversification, and I can say throughout this cycle, we've had none of our clients at all panic and sell, unlike that data that we saw from the rest of the market. So until we talk again, have a great month. Hope you're getting out and about. Lots of our clients are traveling. I've seen lots of news from Europe and other places. And until we talk next time, Rob McGregor signing off.